Well, the recap wouldn't be breathtakingly original, but it's worth reminding people who are pulling their hair out about prices not going where they think they should. And it seems to me every resource investor I know thinks one price or another isn't where it should be. But it's worth reminding ourselves that we were more right than anybody in the mainstream. We are in uncharted waters. We knew that. We've known that since 2008, but the 2020 shutdowns were a big reminder of that. And yet you had all these mainstream people, and this is relevant, you had all these mainstream people on Wall Street, and you had the Fed, central bankers around the world saying, but we're in uncharted waters, but here's our chart, and here's what we're going to do. And trust us, everything will be fine. Well, it wasn't fine. We knew that the fiscal and monetary response to the COVID shutdowns would be inflationary, and we were right. All right, now flash forward to 2022, and it seems like things aren't right. Gold actually ended up the year a smidge up, but largely flat. You know, what happened? What went wrong with 2022? Well, actually, I don't think much went wrong with 2022 at all, given the world that we're in, a world of fiat currencies and a world of central bank intervention. The major drivers over the last 50 years for gold in particular has been real interest rates. And those did curve upwards. They're still negative, but they're less negative than they were before. And so for gold to actually have a sideways year in a year of fundamentally less negative interest rates and nominal negative interest rates disappearing around the world as well, that's really, I think it's quite bullish. It tells me there is serious appetite out there despite the headwinds. And of course, gold is priced in the dollars. We saw the dollar wrecking ball smashing all kinds of things, not just gold, not just commodities, but stocks and other things. So there's so much we can go in retrospective here, Kai. I don't want to be too long-winded. But actually, I think if you take a breath, take a step back and look at the big picture, 2022 was rather affirming of most of our fundamental theses here. Gold led, we saw what was coming, we were right, and the piper is still to be paid. And there's a pretty good chance that we'll see that in 2023.
Oh, absolutely. Let's stick with gold here for a second before we jump around, because we will jump around. There's so many topics that sort of intersect and cross each other's path there. But gold, yes, we held up, right? And but the year was interesting. Like we actually dropped. We were down quite a bit mid-year. We were down to 16.15. Well, and now we closed at about 18.15, like $200 higher. That's a really big swing for gold. Let's look at the reasons for that. Like, why did that change? And I know we talked mid-October at the New Orleans Investment Conference, and the DXY was at its peak pretty much of the year, 114. We're now at 104, 105 right now. What is the reason? I know I already sort of felt like gave away the answer here, but what's your interpretation of what I just made out there?
Well, it's a couple things to remember or take away from that. One is we have confirmation that, and we've seen this in the past. In the early aughts, we saw it in the last big cycle. But the threat of the Fed hiking rates, the idea that the central bankers will increase interest rates, that often hits gold in particular harder than the actual rate hikes. And we have seen times when gold has rallied with rate hikes, as it has this last month or two. The interesting twist sort of for 2022 was that instead of rates portending where the dollar will be and therefore driving gold because gold is priced in dollars, or as I think of it, not the gold price, but the gold dollar exchange ratio, we saw the dollar trading pretty much since the outbreak of the war in Europe very directly with the dollar on Forex, the DXY. And that was an outlier, but it still remains in strength. And it really underscored what our friend Brent Johnson calls the dollar milkshake theory. And so, long story short, what we saw was that Brent was right. And while the dollar was rallying, that was bad for alternatives, including gold. And now we've seen dollar roll over and head down. And that it's kind of funny to have me on a show looking for predictions for 2023 because I avoid making predictions where possible. But I have been saying that I thought that the Fed led the way in tightening, would lead the way in loosening up. And therefore, that would affect the dollar milkshake mechanism. It would go into reverse as the world perceived that the Fed was less hawkish than the ECB. And I think that's actually what we're seeing. I think that analysis was correct. Over the last couple of months, it has certainly benefited gold and silver bugs.
Oh, absolutely, yeah. U.S. dollar definitely trading lower. As a living in Germany, using the euro, I'm happy that the euro is stronger again than the U.S. dollar. That we've left parity. Really happy about that because I traveled to the U.S. quite a bit. And
sorry, let me jump in and just real quick add on. And in terms of looking forward to 2023, I think this is very bullish. I mean, I don't really believe anything a central banker says, but they are trying to provide guidance. And Lagarde did say that they're looking for steady, rate hikes going forward for some time. So, and steady at the last is 50. So basically, she's signaling at least 2 more 50s. And the Fed is signaling, maybe 50-25 or 25-0 or something. So we're seeing that play out. So actually, I think this is very bullish for early 2023. And then, who knows how the recession and everything else hits. But as a forward-looking statement, you've got me here in an unusual spot, Kai. I'm actually willing
to
almost make a prediction.
No, it's interesting but Europe was late to the party raising as well. So of course there's a bit of a time delay in between because Lagarde was just like, as you said, 2-3 months late raising after the US started raising rates already, right? And maybe to fill in, I looked at the Fed Watch tool just before we came on here for our interview, and the next Fed meeting is in 29 days, early February, and it looks like it's 70% prediction is a 25 basis point hike. So they're definitely letting steam out of the kettle or out of the pot here.
Well, again, that's the market, though. That's not based on Fed speak or whatever. The market is pretty aggressive in telling the Fed what it thinks it should do. I think that is pretty aggressive. Because they're really worried about a 1970s repeat, I think, and I would not pull 50 off the table. And if anything, the market sets itself up for pain. If the market rate really, if those odds go really low, and then the Fed does 50 and says, look, we said we still had a way to go, it would be a shock, right? That disappointment to the market would be a real blow. So, but the market, Mr. Market isn't one guy. I can't grab him by the lapels and say, listen, buddy. So we'll just see what happens.
Now it's interesting, like CPI numbers, and I'm having a bit of a deja vu moment because whenever we chat, CPI numbers in Germany come out. When we chatted in October, same day the CPI numbers came out, right? So again, today CPI numbers in Germany came out and they were below forecast, meaning our inflation number was way low, or not way lower, but I think predicted was 9%. We came out at 8.6, right? So there's momentum in that direction, right?
I get that, but I would. And again, who knows? If central bankers, watch what they do, not what they say. But and what they do, by the way, is accumulate gold. But sure. We have the circumstance for Germany with the energy prices and the gas coming down in Europe. They refilled, unusually warm winter, so there's an immediate near-term disinflationary force. And so it's in a way not surprising that the number should be lower than expected. But I think the powers that be understand that may not last. If I was in Lagarde's shoes, I'd fall down. But if I would not assume that this is sustainable, right? So we'll see.